No mai, haere mai, piki mai, kaki mai. Kia ora te whānau and welcome to 30 with me, Guyon Espiner. 30 minutes, one guest, no cuts. What we record is what you get. As a child, Antonia Watson learned about the magic that can be worked with money. Over the years, she has risen to one of the top corporate jobs in New Zealand, CEO at ANZ, the country's largest bank. ANZ is one of the big four Australian-owned banks that dominate our banking sector, which the Commerce Commission says lacks competition and leads to poor deals for mortgages and other banking services. Antonia Watson thinks they're wrong. But to those arguing we need more competition, she says, bring it on. So let's start the clock. 30 minutes with Antonia Watson. Antonia Watson, thank you very much for coming on 30. Great to have you with us.
You're going.
How significant is ANZ to the New Zealand economy?
Well, we're the largest bank. We have over $150 billion worth of lending to the New Zealand economy. So that's helping people into homes, it's helping people start, run and grow their businesses. It's helping us as an exporter and a trader with the world with those trade and capital flows. We also look after people's money. We take deposits, and that's a really important part of our business and one of the reasons we talk a lot about safety and soundness of banks.
If we can go back a little bit to your early attitudes to money and then some of your career, you've said that you were lucky to have a mum who taught you about the magic of compound interest. Have you always been good with money, and has money always been a big motivator for you?
Not so much a motivator, but it was certainly something that, I was lucky. I grew up in a sort of middle-class household. My parents had a small business. They had a pharmacy. I started working in the shop on a Saturday morning from when I was about 13 years old. That's how I earned my pocket money. I had a clothing allowance, so I had to decide how I was going to spend my money on clothes. If it was roller skate or bike time, there was always kind of a co-payment. So I think my parents were very deliberate to teach me the value of money, and that, it certainly affords you choices in life. It doesn't make you happy, and that things, mum's and she's in her 80s now, she's still an active investor. She was very interested in investing and the miracle of compound interest and how, money makes money over time if you're a saver.
Do you think our young people are learning that today in your experience?
Oh, look, I hope so. I think that there's more we can do as a country on financial literacy. I think that that's something we try very hard to. As ANZ, we have sort of 9 financial principles that more and more we've got the ability to use our technology and data to float out those sort of ideas to people and give them little nudges towards savings habits and things like that. So I think that's something that's really developing in our banking system, certainly.
You joined ANZ in 2009, so about 10 years later you become CEO. But if we look back a little further than that, you were at Morgan Stanley when the global financial crisis erupted really in 2008, 2009. Lehman Brothers goes down. People are wondering, is Morgan Stanley, your company, are they next? What did you learn about greed and risk and banking from the GFC?
So I learned a lot, and actually it really shot home when I started working for ANZ, because I was much more in the detail of liquidity and capital and things like that than I had been at Morgan Stanley. At Morgan Stanley, I'd most recently been in Budapest, where I was running a sort of a shared service centre, so we were doing technology and finance and operations for North America and Europe, so I wasn't as close to the heart of it. But one of the things I learnt was people really had all their eggs in Morgan Stanley. I went to New York. I was in New York the weekend that Lehman's failed and that Bank of America sort of bailed out Merrill Lynch. And I watched my colleagues, their jobs were on the line. There was a lot of, you leased your car, you had a big home loan to buy your house that befitted your status. You had a lot of money invested in Morgan Stanley shares. And I sort of learnt this lesson about there was no plan Bs. Everything around their lives was invested in this one company, whether it from their wealth to their job. And I felt like I had a plan B, and my plan B was to come back to New Zealand. And I remember at the time the minimum wage had just been put up, and I thought, the worst case, I'm at my parents' place waitressing, but otherwise, I'll go out there and I'll get a job as an accountant doing something. But people were in New York at that time you just felt like they didn't feel like they had choice.
Was banking a man's world when you entered?
Morgan Stanley more so, yes. ANZ a little bit. It's changed a lot over time. I think banks are probably one of the leaders in diversity in general, and certainly my team now is 50-50, male and female. It was actually slightly dominated by females until recently. And more I find myself, it's an exception for me to be the only woman at the table. In a way, it wasn't the exception 15 years ago.
Let's crack into the banking sector. Does New Zealand have a competitive banking sector?
Well, I think absolutely yes. I put myself in the shoes of our staff, and every day we're out there competing for customers. We're competing to retain them, we're competing to win them, we're competing on interest rates, we're competing. I think one of the things that's a bit different with the banking sector is that, you know, if you're Harvey Norman, you're going in to buy a TV, it's like, well, what is so-and-so charging for it and what is someone else charging for it? The relationship with the bank is longer, it's enduring. So sometimes competition can be around price, and you've seen it, you know, I wouldn't quite call it a mortgage war, but you've seen a lot of competition on price in the home loan space at the moment. Sometimes that's in the deposit space because we need the funding. Sometimes it's in, if you go back to just after COVID, where the home loan market was really, really bubbly. There was a lot of people, there was a lot of competition, a lot of turnover. What we were competing on was turnaround times. Can I actually tell you, Guyon, within a reasonable amount of time that, yes, we can give you a home loan? So competition is very broad. It's how good's our app, for example.
The Commerce Commission, though, found in its recent report on the banking sector that while they didn't find evidence of explicit collusion, they said that we see banks commonly setting growth targets of limited ambition and making decisions to avoid competing too vigorously and instead seeking mutually accommodating growth targets. So you're accommodating, according to the Commerce Commission, rather than competing.
Well, we are not talking to our peers at all, and when we have banking industry things, we're very careful about competition. I mean, we set our own prices based on our own goals. We have our own goals for ourselves. It's to grow our share in home loans. It might be to grow our share in business lending. It might be at a point in time to say, you know, we need more deposits. We need to fight really hard on deposits, or we're not going to be able to lend that money. So that's a decision we make for ourselves.
But they say, and this is the key quote to me on this, that if a hallmark of workable competition is continual struggle with rivals, almost always seeking to do each other harm, the rivalry between the major banks appears to lack this essential trait. Do you get up in the morning trying to do harm to Westpac, ASB and BNZ?
Well, I don't think harm's a very good word to use.
Well, it's the word that they use.
And in terms of banking, what we're looking for is big, strong, stable banks that can look after people's money. So we'd never want to harm a competitor, but absolutely we'd want to win against a competitor. That's what we're there for every day. That's what our pricing committees talk about.
So why don't they see sharper rates more frequently in responding to price changes? I mean, why are the headline rates pretty similar? I looked just before this interview at the 6-month rate, for example. It's, as we record this interview, 6.85. From all the big four banks.
Is that right? The last pricing headlines I was seeing was ANZ's just brought interest rates down, and now Kiwibank's beaten them, and now will make the decision about if we go lower. But I think there's is it a race to the bottom? I mean, we can't put ourselves in a position where we're putting our capital base or our stability at risk by racing to the bottom on price. I think our prices are really fair, and we're absolutely competing every day with you know, 4 big main competitors and a number of other competitors, some banks, some non-banks.
Do you think Kiwi customers are disengaged? Because not many of us switch banks. We don't have the same amount of switching banks as we've seen, say, in the electricity sector, where 20% of customers have switched in the last year. Only 12% of bank customers have switched in the last 3 years. We just don't have that in the banking sector. Why do you think that is?
I hope it's because our customers think they're getting a really good job with really good deal with ANZ where they're standing. We're providing them what they need to look after their financial well-being. But if you take the home loan market, for example, 20 to 25% in recent months has been switching every month. I mean, I think that is significant when you think about, you know, what some of the admin requirements are to change your home loan. I think that's remarkable if we're seeing those sort of switching rates, and to me that demonstrates competition.
Again, the Commerce Commission says the banks have created a dynamic in which consumers must shop around in order to get a good deal. but have not invested in the systems that would assist this process. They say that it's unnecessarily difficult and time-consuming to get several quotes, so competition is much weaker. What's your response to that?
I think Kiwis in general do like to think they're getting a good deal. They're very price sensitive. All our research will say that Kiwis are price sensitive. The part of the market, I mean, there's all sorts of places you can go to see the various rates between the banks. Interest.co.nz would be an example. But also, we've got a really, really strong advisor market. And what we're seeing now is more and more people choosing to go to mortgage advisors who they feel that can sort of do some of the tough negotiating on their behalf, or let them know, what different banks might be offering and what different bank specialties are at a point in time. So that's part of the competition as well that I see working really well.
So do you see New Zealand consumers as apathetic in this regard? What is the reason that we're not switching?
I don't see consumers as apathetic because we're being challenged every day on price, on service, on all those sorts of things. But it's, as I said, your banking relationship is a bit of a lifelong relationship. And if you feel that you're getting a good deal with your bank and they're providing you everything you need and we're allowing you to do real-time payments for free and all those sorts of things, am I going to leave for 5 basis points on my current account? Maybe not.
But you are also deploying retention tactics, aren't you? Like the cashback offers, which you claw back. So you might give a customer $5,000, but if they leave within 4 years, they have to pay. Well, if you leave within 1 year, 75%, 2 years, 50%, and so on it goes. I mean, does that prevent genuine choice when you go to refix, because you'd have to then pay the bank back?
Well, when you go to refix, you would. There is a period of time that you would need to pay back some of that cashback, but that cashback, remember, was the icing on the top when you took out your home loan in the first place, which would have been set in the competitive market that we have. And that's one of the reasons we see advisors shopping around on behalf of their customers. Often you'll get the new bank, that's part of the competition, is like, oh, well, this customer here, I can get them by offering them some new benefits that will make up for the benefits at their old bank.
Why is open banking taking so long in New Zealand?
Open banking it's a really interesting topic. So open banking has been around for longer in other markets. It has been regulated and centralised for longer. So what we were asked to do was set up open banking as ourselves as an industry. And we're the only place in the world that's been done. So I'm really proud of how far we've got. We set up...
but we're well behind Australia and Britain.
And Australia and Britain have had regulation, so the consumer data right that's in front of Parliament at the moment, they've had that for years, and they have what I call like an accreditation agency. So one of the delays we see in open banking at the moment is that if a fintech comes along with a cool idea, and we are open to these because, these are people doing great things for our customers, and it's avoided us needing to do this thing with the technology. But we're having to go to them and say, okay, you're asking for our customers' data. We need to understand how safe is the data? What's your cybersecurity like? What is what's the risk balance equation between us? And we have to do that individually for each fintech, and each fintech has to do that individually with each bank. What the regulation will give us is an accreditation agency that will speed that up, because the accreditation agency will do it once. It will be absolutely clear that if someone moves their money to someone's digital wallet, that it's now the digital wallet's, problem or theirs to keep the risk. But that doesn't happen at the moment. We can't even talk as banks about how we'd mitigate risk of, it's your data that you're saying to ANZ, oh, you give it to someone else.
Sure, but open banking standards and protocols are being developed by Payments New Zealand, and that's owned by the major banks. In fact, you're a 26% shareholder in that company. I mean, isn't that a conflict of interest? You're expected to be developing this disruptor to your dominance in the market, yet you own more than a quarter of the company.
But who else was going to do it? That's the problem. It hasn't been set up like in other countries where a regulator or the government has taken on that thing. So we've done it because no one else was doing it.
Are you denying that the banks are dragging their heels on this?
We're not dragging our heels. I think one of the things...
Do you want open banking to be widely used in New Zealand?
I think you used my words from that. Bring it on, absolutely, because we have there are open banking.
So when would you
fintech.
expect it to be widely available in New Zealand?
It depends on what you're talking about. So the payments APIs have been developed, and we're actually now working one by one with fintechs, as I say, one by one, because we don't have that accreditation agency. So we've onboarded them. So we, for example, you can now pay through BlinkPay, who've got a really good product. There'll be more. There's going to be more functionality rolled out in November around sharing more of your data. So all those things are really good. That it will happen sort of systematically. The Big Four have made a commitment to have all these things done by November. There'll be more types of data that we'll be able to share over time. But open banking's live. It is a bit slow because of all these individual bilateral relationships that have to be established.
Let's talk about profit. ANZ make about $2 billion in profit. How much of that goes back to the parent company in Australia?
It depends.
Roughly.
It depends on look, over time, you'd probably say 70%.
So most of that money, about 70% of the money, goes back to Australia.
Well, no, it doesn't go to Australia. It goes to ANZ's 500,000 shareholders around the world, of which numerous of them are in New Zealand through KiwiSaver funds. So yes, it goes back to our shareholders who have invested $17 billion in New Zealand to provide us the capital that we need to be able to lend to Kiwis.
Why do the Big Four, including ANZ, make such big profits compared to banks in other countries? If I look at the Commerce Commission, they say that New Zealand had the third highest average post-tax return on equity relative to 20 comparator countries. Only Canada and Hong Kong were bigger. So in other words, you're right up the top there in terms of profit. Why is that?
So one thing is a uniqueness about our banking system. So our large banks don't tend to be domestically owned. They're owned by shareholders around the world. So in most of the comparator countries, they have domestically owned banks. So what we are reliant on is our shareholders being willing to invest that, in our case, in ANZ's case, $17 billion in ANZ, and they require a return on that. If you look at those, and our returns modestly above our cost of capital.
I find that really interesting. Yeah. You are saying that it is the Australian ownership, it's not necessarily Australia, but an overseas ownership that means that they are taking more profit out of New Zealand?
No, I'm saying that overseas ownership is relying on foreign direct investment into our banking system is one of the reasons we need to make sure that we're returning those shareholders, at least cost of capital. And cost of capital is the minimum that a shareholder would want to be able to invest in your company. If you look at those 20-odd countries that the Commerce Commission looked at, the question that what they said is true. The question they didn't ask, which is where I feel that they've made an error, is that do we want to be those other countries? And what some of the circumstances of the other countries, so think about it, a load of European countries, they had a really tough time during the GFC. They then had the euro crisis. They are still earning well below cost of capital. They're trading, if they're listed, at less than book value. Their own European Central Bank governor is saying, we're concerned about the stability of European banks because
and
they're
no one
not
wants that.
profitable
But let's focus on Australia because that's where the parent company is domiciled. Why is ANZ here more profitable than in Australia?
I don't think that's right. I think there's it's
hang
really
on.
important.
Is that not true?
It's not. So the best way I think of looking at it is, does mum and dad in Australia and mum and dad in New Zealand get about the same deal? And the best way of looking at that, because it's really hard to compare on an apples for apples basis, because ANZ is a group of is a group that operates in 30 countries. If you look at net interest margin, so that's the difference between what on average, what we are earning on our lending compared to what we pay on our deposits. This is all publicly available information for ANZ and New Zealand. So what we call our New Zealand division, it's a group construct, which is our consumer, small and medium businesses and agribusinesses. The net interest margin is 2.56%. If you compare that to the two like business in Australia, which is our Australia retail business and our Australia commercial business, their net interest margin at March this year was 2.52%. So there's a 4 basis point difference.
The figures I saw were 1.56 for net interest margin for Australia as of the 6 months to March.
Yeah, so, and I'm really glad you brought that up because there's some commentators who are probably being a bit disingenuous because that number is the net interest margin for the entire ANZ group everywhere in the world, and it includes, really importantly, our institutional and markets businesses. And markets has a big negative impact on margin. And our institutional business earns a lot of its income not from interest but from fees. So it wasn't a like-for-like comparison. It's a very different number, that 1.56
So
to the 3.56.
are you saying that ANZ in New Zealand is not more profitable than ANZ in Australia?
No, if you're looking at, what are our businesses and our consumer customers pay, what's the difference between what we pay them on deposits and what we earn from them in our loans, it's there or thereabouts.
Is ANZ contributing strongly to New Zealand's productivity if you have so much of your lending going into the home lending market? It's more than 70%. I looked at these numbers. About 50% of your lending in 2011 was into the housing market. It's now up to about 72%.
So, we go where the customers want to borrow.
And you go where the profit is, and that's where the money is, right?
Well, the money, we would lend out any money to anyone where we can make a proper return on the capital that's deployed. So it's not we prefer home owners over business owners at all. But
there's a risk element, and this draws again into the Commerce Commission findings, because they say you're making profits well and above what you would expect given the vanilla or the low risk areas that you're going into, that they would expect lower profits because your risk profile is low, given nearly three-quarters of your lending is to home loans.
Which is interesting when you think that our profits are only just above our cost of capital, pretty modestly above our cost of capital. But when you think about New Zealand, there's a lot of talk about us not being risky. I mean, New Zealand is a small, open economy that at the bottom end of the world, that relies on trade and capital flows. It's subject to weather events. We know for a fact that when we go to the wholesale markets to borrow money, they treat New Zealand as more risky than Australia. Therefore, we have to pay more for our wholesale money than the Australians do. So I challenge the idea that we're a low-risk economy. I think that, being a small, open economy naturally makes us a little bit more risky. And then the other thing I'd say is that when you look at where our capital is deployed, more capital is deployed against business and agri-lending than against home lending. 51% of our capital against business and agri-lending and 41% against home lending. So we're taking more risk on business and agri than we are on home lending.
New Zealanders look overseas to countries like the UK, but especially America, and where you can take out a 30-year fixed loan, maybe at 3%. And when you break it, there's no real massive penalty. Yet here we are in New Zealand, paying pretty high interest rates and having to fix the things every 2 years. Why can't New Zealanders fix for 30 years?
Now, this is going to get I'll try and explain this simply. So when how we run our balance sheet is based off a floating rate. We want everything to be all moving together. So what that means is if I guarantee you that you can pay me 6% for the next 1 year, I want to hedge that. So it's like remove that risk that for no matter what happens for 1 year, I'm going to get 6% off you whether interest rates go up and down. So that's what you want. You want the fixed nature of it, the certainty. We want the certainty that it's floating with the market. So we go out and say to someone, who wants to take Guyon's interest, 6% fixed, and give me back as the bank the floating rate? So that's what's called hedging. In New Zealand, we can't hedge for 30 years. In the US, they can. They've just got much deeper markets. They've got government bonds that have been issued out 30 years that can act as that hedge and provide that market for rates that long. We just don't have depth in our market out past sort of about five years.
There used to be a 7-year rate from memory.
Yeah, and no one took it up.
No one took it up. But couldn't we have 10 to 15-year rates?
Depending on our ability to hedge it, it would be more expensive to hedge because there just isn't the supply and demand.
When you say you couldn't do
it,
you wouldn't make nearly as much money doing it that way. Is that what you're saying?
Probably that you would have to pay a lot more money for it because of the lack of supply and demand at that part of the interest rate curve, because there isn't any trading there. There aren't any. It'd be very hard for us to hedge, and naturally we'd have to pay more for that. So naturally you'd have to pay more for your home loan.
So we do pay more for home loans in New Zealand than other comparable countries, don't we?
It depends on what countries you're talking about. But if you're thinking Australia at the moment, absolutely. Our OCR is a percent higher than Australia. As I was saying before, we pay more for wholesale money than the Australians because we're perceived as a more risky economy. So, yeah, it depends on OCR, it depends on what the individual country's interest rate is expected to do over time.
You've talked about bring it on in terms of the competition. If Kiwibank was capitalised that it could really become a competitor, well, firstly, do you see Kiwibank really as a competitor?
They really are a competitor.
Well, they've only got 7% of the market. You've got 30% of the home lending market.
Only 7% in 20 years is remarkable. I mean, we've been around since 1840, don't forget, and we've had a number of mergers and acquisitions on the way. So that is actually phenomenal growth. They're taking, in terms of flow, they're taking 20 to 25% of home loan flow at the moment. I think kudos to them. They're competing really hard and they're winning home loans. The problem is it doesn't reflect on their market share very quickly, because even if you win 25% of the new loans and you're only at 9% of the market, say, a whole lot of people are paying back their home loans in the same month. So it doesn't flow through in bank market share like it would if you start from zero at the beginning of each year, like if you were a car dealer, say.
Do you expect the government to sell down some of Kiwibank, or however you're going to capitalise it, and have them being better able to compete with the Big Four?
Look, that's up to the government. We have no issue with that. We're absolutely happy with any competitor that that keeps us on our toes. We are in a competitive market. We're happy for it to continue to be competitive, and if it gets more competitive, that's good for our customers.
Let's spend the last 5 minutes or so looking perhaps at some broader economic questions. I mean, you've talked about ANZ having a role in getting more Kiwis into quality housing. In fact, you've called that a strategic goal. You at one point said that you raised the deposit rate for investors to 40%, not because you had to, but because you saw it as the right thing to do for the country. And it took some froth out of the market. So you obviously see yourself as having a bit of a broader role. What are your views on a capital gains tax?
So if you take back, I might use my parents as an example. So they had a pharmacy. That was their wealth, effectively, was based on the value of their small business. Do I think there should be, capital gains tax means many things. Do I think there should be a wealth tax? No, an unrealised wealth tax that you have to pay every year. How would they have paid that over the time as their business grew in value? However, at the time they sold their business, a capital gains tax on realised gains. Look, I think that it's true that in this country, people are investing in housing for the purpose of getting a capital gain on it. And if that's the purpose of it, why not have that as part of the tax take?
Have a capital gains tax on
realised gains.
Yes, and just for people who don't know all the terminology, that means at the point of sale, rather than just saying, your house is worth $1 million, I'm going to tax you on that. But what you're saying today is when you sell your house, you should pay a capital gains tax on it.
Once you've got the money in the bank, that is absolutely an option that we'd have as a country doing. One thing it will do is it'll give a whole lot of work to accountants and lawyers, and that's why in the past I've been a little bit reluctant. I've lived in countries with capital gains taxes.
Well, most of them do.
I know. What happened was we didn't sell anything. But eventually that time comes, and I think that there is some fairness in saying that a gain from a capital gain compared to a gain from your income. I mean, I'm mainly a wage and salary earner, and I pay tax on that. I think that's fair, but I don't think it's fair to tax something that doesn't exist, in the bank that you can easily pay.
No, but on a sale of a property, you believe that there should be a capital gains tax on that.
And there tends to be exclusions for family homes and things like that, which I think is fair. But, we have an investment property at the moment, which we ended up with in circumstances. I actually prefer to invest in share markets and equities and things like that. I know that it's not really making, a decent return in terms of a cash flow sense. So that says to me, the rationale for investment is very much partly capital gains. We're in a country where there isn't enough of a supply of housing. There is competition for it. So how do we encourage,
So the time has arrived for a capital gains tax?
If someone had the courage to do it, which I think would be politically extremely courageous, we've seen the impact in time, but if someone had the courage to do it, I wouldn't be jumping out of bed with joy, because I did my dissertation on tax compliance costs. It's a hard tax to comply with, and I think we have to be really alive to that. But in terms of the overall fairness, it's probably a fair way to tax another part of income in this economy.
Just finally, what's the biggest threat to ANZ as you see it? You're the dominant
biggest-
player. You're the biggest player by quite a margin.
Yeah.
What threatens that position?
So I could say competition, because obviously that's a threat. If we're the biggest player, we have to win 1 in 3 home loans just about to stay still. So if that's not a competitive impact on me, I don't know what is. But I'll tell you the other thing that I think is, what would really keep you awake at night? The Reserve Bank gets us to run stress tests every so often to see, what will break the bank. And it is really hard to break a bank now because we're very well capitalised. We've got great liquidity. We lend in a different way than we have in the past. Things like cybersecurity, things like that. That is something that, if we think of a plausible scenario, it's things like cybersecurity comes along with some foot and mouth disease, some terrible weather events. You actually have to layer on risk after risk after risk, and that would be the threat.
Let's hope that doesn't eventuate for all of us. Thank you very much for coming in this morning. We really appreciate your time.
Thanks for having me.
That was 30 minutes with Antonia Watson. This is 30 with Guyon Espiner. We'll catch you next time.